In the wake of recent global events, financial markets have once again faced a major jolt. This time, a sharp tariff hike between major trading nations has triggered widespread uncertainty, leading to a significant crash in the stock market. For investors, such moments can feel overwhelming, filled with fear, confusion, and pressure to act quickly. But in times like these, strategic thinking and long-term planning can make all the difference. Understanding the impact of tariffs on the market. Tariff hikes generally lead to increased production costs, reduced corporate margins, and higher consumer prices. Supply chains get disrupted, trade flows shift, and investor sentiment takes a hit. Historically, tariffs have been linked to short-term market volatility and long-term structural adjustments in global commerce. The most immediate impact is often felt in trade-sensitive industries like manufacturing, tech hardware, and automotive sectors. However, the ripple effect can reach nearly every corner of the economy, dragging down broad market indices and shaking investor confidence. 1. Keep a long-term perspective. First and foremost, do not panic. Market crashes are painful but not permanent. Investors who react emotionally, selling in haste or abandoning their long-term plans, often lock in losses that could have been avoided. History has shown that markets tend to recover over time. Whether it's the 2008 financial crisis or past trade war periods, patience and persistence have rewarded disciplined investors. Staying invested, especially in quality companies, is key. A tariff-induced crash doesn't necessarily change the long-term fundamentals of every business. It's important to separate temporary noise from lasting structural shifts. 2. Rebalance and diversify. This is the time to revisit your portfolio. Has it become too concentrated in sectors hit hardest by the tariffs? Are you overly exposed to international equities or certain emerging markets? Diversification, spreading your investments across different asset classes like domestic and international stocks, bonds, commodities, and even cash, helps cushion the blow of sector-specific or country-specific risks. Global diversification can particularly help when certain regions are more impacted by trade policies than others. Consider adding assets that are less correlated with equities, such as gold, which often performs well during periods of uncertainty. 3. Invest in defensive and essential sectors. During uncertain economic times, not all companies are affected equally. Defensive sectors, such as healthcare, utilities, and consumer staples, tend to maintain steady demand regardless of economic cycles. These sectors usually show more stability during downturns and may offer safer ground while the broader market remains volatile. Companies that provide essential products and services are more resilient to changes in consumer spending caused by economic stress. 4. Keep cash reserves for strategic moves. Having cash on hand gives investors flexibility and the power to act when opportunities arise. During market crashes, valuations drop, and fundamentally strong companies may become undervalued. This doesn't mean hoarding cash indefinitely, but rather maintaining enough liquidity to deploy when prices become attractive. It's also a cushion for personal expenses, reducing the need to sell investments at a loss during emergencies. 5. Review your risk tolerance and goals. Market crashes are the ultimate test of your investment personality. If recent events caused sleepless nights or impulsive decisions, it might indicate your risk tolerance was higher on paper than in reality. Now is a good time to review your investment plan. Are your goals still aligned with your current strategy? Does your asset allocation need adjustment based on your time horizon, income needs, or risk appetite? An honest reassessment helps refine your approach, making it more resilient to future shocks. 6. Stay informed and think rationally. Tariffs and trade wars are complex. They involve political, economic, and global considerations. It's important to understand both the short-term noise and long-term implications. Stay updated through trusted financial news outlets, market analysis, and economic reports. At the same time, avoid being swayed by panic-driven headlines. Use reliable data and insights to shape your decisions. And if the market feels too overwhelming to navigate alone, don't hesitate to consult a certified financial advisor. A second opinion often adds clarity during volatile times. Final thoughts. A market crash sparked by a tariff hike is a storm, but it's not the end of the financial journey. Investors who stay calm, think long-term, and act strategically can not only survive these periods but emerge stronger. This is your moment to reinforce your investment foundation, refine your approach, and build towards future gains. Thanks for watching Global Insight Hub. If you found this breakdown helpful, make sure to like, follow and subscribe to our social media platforms, and drop your thoughts in the comments. How are you navigating this volatile market? We'd love to hear from you.